You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Deep Dive. We are jumping into some really key global market and policy briefing material today.
Yeah, the kind of stuff that connects those big summit decisions, directly to what happens in currency and commodity markets.
Exactly. So our focus is right on that intersection. Central bank moves, trade talks, and, well, those simmering geopolitical tensions that are always in the background.
That's the plan. We're connecting the dots for you across FX, commodities, tariffs, geopolitics.
Trying to see which drivers really moved the needle in the last day or so.
And why. So you get a quick but hopefully pretty thorough grasp of all these cross-currents.
Okay, so let's dive in. And we really have to start with that initial market reaction, the surprise around the Federal Reserve.
Right.
They cut rates by 25 basis points. Now, normally that's easing, should weaken the dollar, but the dollar actually got firmer. That seems paradoxical. What's the story there?
Well, it really wasn't about the cut itself, interestingly. The market focus was completely on the forward guidance. So yes, the Fed cut 25 points. But Chair Powell, he paired that move with what the briefing called a pretty hawkish message.
Hawkish meaning?
Meaning he was very clear, stressed that another cut anytime soon is, and this is the quote, far from assured.
Okay, so the action was easing, but the vibe was tightening. The message was, don't expect more of this.
That's the core message the traders jumped on. And that guidance, well, it pushed the greenback higher.
Strengthen the dollar against other currencies.
Yep. Which naturally put some immediate downward pressure on gold, at least at first.
Right. It really shows how much future expectations matter more than the present policy sometimes.
It really does. It's all about reading the tea leaves for the next move.
Okay, so let's follow that ripple effect into Asia FX, because the Fed's decision obviously doesn't happen in isolation. Let's start with Japan, the BOJ.
Sure. So the Bank of Japan, they held policy steady, unchanged. That was, pretty much expected.
Okay, no big surprise there then.
But the interesting part is often in the details, the internal mechanics. We saw two board members, Takada and Tamura, they actually dissented.
Dissented how?
They argued in favor of a hike.
Wow, okay. A two-person dissent might sound small, but why is that detail so significant for, say, yen traders?
Because it immediately flags upside risks for the yen. Even though policy didn't change now, that split vote tells the market there's a growing group inside the BOJ ready to tighten.
So it keeps traders on alert, stops the yen from weakening too much.
Exactly. Keeps them watchful, prevents any big sell-off.
Okay. Meanwhile, over in China, the PBOC, their central bank, was more focused on stability.
Correct. The PBOC delivered what's called a stronger-than-model daily fix for the yuan.
What does that mean in plain terms?
Basically, they set the official yuan rate a little bit stronger than market models might have predicted. It's a signal.
A signal they don't want the currency to weaken too much.
Precisely, resisting excessive weakness. And that helped keep Asia FX fairly stable while everyone was kind of watching the U.S.-China summit news.
Right. Let's look at a couple of other currencies. The Aussie dollar, the AUD, it held on to recent gains. That seems a bit odd after a hawkish Fed signal.
Yeah, the AUD is interesting. It's being propped up by something purely domestic, inflation. Their Q3 CPI, consumer price inflation, came in hotter than expected. Hotter Q3 CPI was a briefing note.
So strong inflation locally.
Means the market quickly dialed back expectations for any near-term rate cuts from the Reserve Bank of Australia. The currency is getting support from the need for higher rates at home.
Got it. Local factors winning out. And just to complete the picture on the Fed's influence, the Hong Kong Monetary Authority, the HKMA.
Yep, they followed the Fed, cut by 25 basis points too. That's pretty standard given their currency pegged to the U.S. dollar.
Right. Textbook move because of the peg. Okay, let's pivot now. Connect this firmer dollar, these mixed central bank signals. How did that play out in the commodity markets? Gold and oil specifically.
Well, gold, as we touched on, it initially slid a bit. That hawkish tone from Powell made the dollar look more attractive, so gold softened.
But it didn't collapse.
No, it found its footing pretty quickly. Stabilized back towards that USD 2,000 per ounce level, Markets seem to balance the actual easing the rate cut against that cautious guidance. Plus, gold is still that long-term hedge.
Making sense. And what about oil? The briefing called its performance lackluster. Seems stuck.
It really is caught in a bind right now. It had a small pop after the EIA inventory data, but that faded fast.
Why?
It's getting weighed down mainly by the macro picture, that strong dollar, which came straight from the Fed news. That's a big headwind.
And that's overriding other factors
Yes.
like supply issues or geopolitics.
For now, yes. That macro pressure from the dollar seems to be keeping a lid on things despite the usual supply noise and, geopolitical risk premium that often pushes oil up. It's just in a tight holding pattern.
Okay. How about base metals? Things like copper. It had a strong run, but eased back a bit.
Yeah, copper came off its recent highs, but it had a really powerful run-up.
Yeah.
The medium-term outlook for base metals there still looks pretty solid, according to the briefing.
What's supporting it?
Two main things highlighted. First, those sort of incremental signs, maybe whispers of U.S.-China trade tensions easing. That's good for industrial demand.
Right. Metals need smooth global trade.
Exactly. And second, there are still ongoing concerns about global supply for many of these metals. That tends to put a floor under prices, even with short-term macro wobbles.
That's actually a perfect segue into the main policy driver from the briefing, that U.S.-China summit. President Trump called his meeting with President Xi amazing, said lots of decisions were made. What were the actual concrete takeaways, the deliverables?
They were quite specific, focused on easing some immediate friction points. The big one for agriculture, China agreed to immediately resume buying U.S. soybeans.
That's huge, symbolically and commercially.
We're absolutely a major reversal. Then on tariffs, two key things. Tariffs on fentanyl-linked items, those were cut to 10%.
Okay.
And other sort of headline tariff rates were also lowered. This is part of a one-year arrangement, apparently, which President Trump said he expects to extend later.
A one-year deal for now. And what about that critical issue for tech and industry, rare earths?
Yeah, that was a really significant point. Trump stated the rare earths issue had been settled.
Settled, that sounds decisive.
It does. It suggests a major potential roadblock for critical minerals trade has been, removed, at least for the near term. And importantly, both sides said they'd keep their working level teams talking.
So the negotiation channel stays open, even if it's complex?
Exactly. Suggests ongoing dialogue.
But here's where it gets really tricky, right? The whole technology divide, especially advanced chips. We saw conflicting signals almost immediately.
Absolutely. Total conflict. The White House signaled, it was willing to talk to NVIDIA and others about taking chips. That hinted at maybe easing some tech export controls. But almost in the same breath, congressional leaders were out there publicly urging the administration not to lift restrictions on advanced AI semiconductors.
So a real tension there between, say, getting an immediate trade deal versus long-term national security or tech leadership concerns.
That's the core conflict. It highlights how difficult it is to balance immediate economic de-escalation with these longer-term strategic technology goals.
We also saw some other trade moves in Asia.
Yes, a couple of things. A U.S.-Korea trade package was announced. It seems to feature quite large energy purchases and investment commitments from South Korea.
A significant energy security angle there.
Definitely. But on the other side of that coin, Japan sounded a note of caution. They basically said a ban on importing Russian LNG would be really difficult for them.
Underscoring the practical challenges of shifting global energy flows quickly.
Exactly. Even with all the geopolitical pressure, the reality of supply chains is complex.
Okay, this brings us to our final segment. Those geopolitical undercurrents. And we should stress, as the briefing did, that while these headlines are important background noise, they didn't really seem to materially change market prices on this particular day.
That's a key distinction. They add to the overall risk environment, the long-term uncertainty, but they weren't the main driver today.
So what was bubbling under the surface? Middle East.
Yeah, in the Middle East, Israel reported some renewed enforcement actions around the Gaza ceasefire framework, and they signaled, potential further responses if violations continue. So, still very tense.
Volatile, yeah. And North Korea also made some noise.
They did. Launched a missile. It was characterized as part of their nuclear forces capability. That keeps regional risk premiums elevated, especially for South Korea and Japan.
Always keeping the pressure on.
What else? We also saw China and India held another round of border talks focusing on that contested Western segment. They agreed to keep military and diplomatic channels open.
Which is positive, at least in terms of communication.
Right, a necessary step for de-escalation, even if the core issues remain.
And finally, some U.S. actions noted.
A couple of things. Additional statements on nuclear posture, and also a reported kinetic strike, meaning a military strike on a drug trafficking vessel out in the Eastern Pacific, all part of that constant flow of global security events.
But again, not immediate market movers this time around.
Not this time, no. So, if we pull it all together, the immediate picture is we've got a firm dollar, almost entirely thanks to that hawkish Fed guidance,
Right.
a watchful yen because of that split vote inside the BOJ,
Mm-hmm.
an Aussie dollar holding its ground because of strong domestic inflation.
Yep.
And commodities, especially metals, are kind of calibrating, balancing the Fed's tone against those slightly positive signals from the U.S.-China talks.
The great synthesis.
Yeah.
Crystal clear. So looking forward then, where does market attention go next? What are the key things to watch?
Okay, immediate focus probably shifts to Europe. We've got the ECB decision coming up, plus broader euro area data that could definitely inject some volatility into the euro-dollar exchange rate.
So Europe takes center stage short term.
Short term, yes. But the more lasting driver will be the follow-through on that U.S.-China summit readout.
Specifically.
Markets will want to see hard evidence. Are those soybean purchases actually happening? What are the precise details of the tariff adjustments? And critically, what are the final rules around tech exports, especially those advanced AI chips?
That's where the rubber meets the road.
Exactly. That's what will likely shape the next major move for currencies and for base metals.
Okay, so as we wrap up this deep dive, let's leave our listeners with a final thought. We saw today, or in this briefing period, a really immediate, sharp market reaction to central bank guidance.
The Fed spoke, the dollar moved instantly.
Right. But the briefing also detailed these really specific high-stakes negotiations, settling rare earths, debating AI chip restrictions, things that move much more slowly.
Yeah, the slow crawl of policy versus the quick jump of market sentiment.
So the question for you to ponder is, which ultimately has a greater long-term impact on global stability, on resource flows? Is it the quick, sometimes volatile reaction to a central bank statement? Or is it that slow, technical grinding work on high-level trade deals that fundamentally redraws critical supply chains?
Something to think about as you navigate the markets. We'll catch you on the next deep dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.